Have you ever heard someone say you could be your own banker? It's a pretty bold claim, right? Well, it's at the very heart of a popular and, let's be honest, very controversial financial strategy called the infinite banking concept. So today we're going to break it all down: what it is, how its fans say it works, and of course, what the critics have to say about it. The whole strategy really boils down to this one very appealing question. What if you didn't have to go to a traditional bank for a loan? What if you could build your own financial system, one that you have complete control over? A system you could use to fund big purchases, cover business costs, you name it, all while essentially paying yourself back. It's a powerful idea. All right, so here's the game plan for this explainer. We're going to start by defining what this whole concept actually is. Then we'll walk through the five-step plan that advocates lay out. After that, we'll dig into how the loan part works, because that's a huge point of confusion. Then we'll get into the big debate, the pros versus the cons, and wrap it all up with the bottom line. Okay, let's get into it. First things first. When people throw around the phrase, become your own banker, what are they actually talking about? Okay, so the infinite banking concept, often just called IBC, is a strategy that basically turns a specific kind of life insurance policy, a permanent whole life policy, into your own personal bank. The core idea is that you build up cash value inside that policy, and then you use that pool of money as your own private source of financing. And this isn't some brand new idea. It was actually developed way back in the 1980s by a guy named R. Nelson Nash. He was looking for a way around high-interest bank loans. He finally published his book on it in the year 2000, and ever since, it's just exploded. It's now a well-known strategy with some seriously dedicated followers and, you guessed it, some very vocal critics. So you might be wondering, how do people actually do this? Let's walk through the 5 steps, and we'll look at it from the perspective of someone who's a big believer in the strategy. So from a 30,000-foot view, the process looks something like this. First, you get a very specific type of whole life policy. Second, you make sure it's designed for maximum cash growth. Third, and this is a big one, you fund it aggressively. Fourth, you use that cash value you've built up to make your purchases. And finally, you pay that loan back to your own policy, but on your own schedule. Step 1 is the absolute foundation, and proponents are super specific about this. It can't be just any policy. It has to be a participating whole life policy, and it has to be from a mutual insurance company. Now, that mutual part is really important because it means the policyholders are technically part owners, so they can get a slice of the company's profits in the form of dividends. Now, just getting the policy isn't enough. You have to design it the right way. The whole thing has to be structured to maximize your cash value right from the get-go. And the main tool for this is something called a paid-up additions rider, or PUA. Think of it like a feature that lets you stuff extra cash into the policy. Every time you do, that money buys a little slice of paid-up insurance, which instantly boosts your cash value. It's no wonder advocates call it the turbocharger for growth. And that leads us right into step 3, which, honestly, can feel a little backwards. Instead of trying to pay the lowest possible premium for your insurance, proponents say you should overfund it. You want to pay in as much as the IRS will let you before the policy loses its special tax status. The whole point is to get as much capital as you can into that cash value engine you're trying to build. And here it is. This is where the whole banking part really comes to life. Once you've got a good chunk of cash value built up, you can start taking out policy loans. Let's say you need, $40,000 for a car or to expand your business. Instead of filling out a bunch of paperwork at a bank, you just borrow against your policy's cash value. Then you pay that loan back plus interest to yourself. And the big selling point here is flexibility. You're the one who sets the payback schedule, not some loan officer. Okay, let's pause. That whole loan thing, that's where most people's heads start to spin. And it's where the debate gets really intense. So let's take a second to unpack this central mechanism, because understanding how it works, or how people say it works, is absolutely key to the whole concept. Yeah, this question, which I pulled from a discussion on Reddit, really gets to the core of the skepticism. It's like, wait a minute, how can my money still be growing in the policy if I've taken it out as a loan? I mean, that sounds impossible, right? You can't have your cake and eat it too. And that leads to 2 totally different ways of looking at it. Proponents will tell you, with a straight face, that your entire cash value, including the part you've borrowed against, keeps on growing and earning those potential dividends. But critics, they say that's just slick marketing talk. They say you're just borrowing your own money and paying interest for the privilege, plain and simple. So here's the technical explanation that's at the center of this whole disagreement. The way proponents explain it is this. When you take a loan, the money doesn't actually come out of your cash value. It comes from the insurance company's big pot of money, their general account. Your cash value is just put up as collateral. And because your money never technically leaves your policy, they argue it continues to grow and compound without interruption.
Okay, so now that we've got that tricky mechanism on the table, let's zoom out and look at the bigger picture. The full debate between the people who love this strategy and the people who are, well, not so convinced.
The first big showdown is over control versus cost. On one hand, proponents just love the idea of having total financial control. Need money? It's there. No applications, no credit checks. But on the other hand, critics argue that this control comes at a really high price. They point to the huge agent commissions, the ongoing policy fees, and the massive surrender charges if you try to get out early. Next up, growth versus returns. The advocates, they champion the guaranteed and steady growth of the cash value. They see it as a safe harbor, totally protected from a wild and crazy stock market. But critics fire right back. They say, sure, it's safe, but the returns are often pretty low compared to just investing in a 401k. And you might have to wait years and years just to break even on all the premiums you've poured in. And finally, we get to the big philosophical question. Is infinite banking this brilliant, sophisticated strategy for financing your life and building a legacy for your family? Or is be your own banker just some really clever marketing language that's been slapped on top of a high-commission insurance product that's really designed to be sold, not bought? So critics usually propose this other pretty well-known philosophy. Buy term and invest the difference. The idea is simple. Instead of bundling your insurance and your savings into one expensive whole life policy, you should buy cheap term insurance just for protection. Then, you take all the money you saved on premiums and invest it in a low-cost, market-based account, like a 401k or an IRA. Wow, okay, so with all that back and forth, what are the facts? What are the core things about this strategy that pretty much everyone, proponents and critics alike, can actually agree on? Let's get to the bottom line. Look, whether you think this is genius or a bad deal, these points are not up for debate. Number one, the whole thing is built on a permanent whole life policy. 2, this is absolutely a long-term play. It's not a short-term thing. 3, you have to pay high premiums to make it work. 4, you get your money out through policy loans. And 5, because of all those upfront costs, the cash value grows very, very slowly in the early years. And that slow start is such a critical thing to understand. One financial planner who's not a fan of this strategy pointed out that you could be waiting 7 years, or maybe even longer, just for your cash value to finally equal the amount of premiums you've already paid in. So yeah, this is not a get-rich-quick scheme by any stretch of the imagination. So in the end, we're left with this fundamental question. Is this concept a truly powerful tool for financial freedom, one that gives you total control over your own capital? Or, like the critics suggest, is it really just a complicated and expensive system that's basically a fancy IOU to yourself? That's the question at the very heart of this whole debate.